a value add multifamily apartment complex where you can come in and over a couple of years upgrade all the units and significantly increase all the rents. That's going to significantly increase your net operating income over a couple of years. And so that's the velocity I'm talking about in terms of how quickly you can increase the NOI and thereby significantly increase the overall value of the property.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today, again, is Zach Winter. We're going to welcome him back to the show. We're going to jump right back in and why multifamily and why value add for them. You're going to hear him talk about both sides of that coin a little bit. But even on the passive side, like why not just be passive? Oftentimes we have many attorneys and let's say high income folks like that they just want to be passive, right? And then obviously there's some that decide they want to go be active in real estate versus that position, that they had. And so you're going to hear that also, and amongst many other things, as we close down some of those last questions. It's always interesting some of the answers we get, and Zach just brings a lot of value to you today. Zach, welcome back to the show. I want to remind the listeners to go back to yesterday. You're going to hear more about Zach, their firm, and I mean, just really learning about his background as an attorney, how it's helped them in the business, but then some tips he provided for just our relationship with our attorneys, and as you grow in this space, and some different documents that you need to be aware of. Zach, let's jump back in. I know you mentioned yesterday, like you all like value add versus ground up and some of those things. But I want to get into that, but I also want to know, why multifamily for you? Like why, I think you had said something, obviously it's a highly desired asset class, but why still pursue multifamily for you and your group?
Yeah, great question. So, I think multifamily, as it turns out right now, it's the best performing, commercial property asset class. And one of the reasons is there's just a huge lack of housing throughout the US, a huge need for housing, and people always need a place to live. And so that's continued to drive the multifamily market versus, if you compare it to traditional office, people are working from home. There's a real difficulty here in the US to get employees to come back to the office. And so we're seeing these, high-end Class A office buildings where they're turning the keys back into the lender. So multifamily, it's been a very steady, very reliable property type for us. And, the reason we like value add multifamily is really the velocity in terms of how quickly we can increase the value by increasing the net operating income. So if you compare it to yesterday, we were talking about the fact that we own a couple of industrial flex office parks. Great asset class, very safe, very secure. They're all triple net lease tenants, right? And so it's very easy to predict what our net operating income is going to be. And those leases are long-term leases, and typically will build in, some annual rent increase. It's very moderate in terms of the annual increase in your NOI. If you compare that, on the other hand, with acquiring a value add multifamily apartment complex where you can come in and over a couple of years upgrade all the units and significantly increase all the rents, that's going to significantly increase your net operating income over a couple of years. And so that's the velocity I'm talking about in terms of how quickly you can increase the NOI and thereby significantly increase the overall value of the property. So we find that, with this value add multifamily, we can cycle through a property in 3, 5, 7 years. For some of these other property types, you're holding for a much longer period if you're trying to achieve a similar IRR.
Yeah, for sure. No, completely agree. We like that space, obviously, as well, for sure. So have you all done some ground up?
No, we haven't done ground up. We're involved right now in a hotel to apartment conversion project, and that's probably the most intensive renovation project that I've been involved in to date. But we haven't done ground up. It's not something that's in our skill set. So if we were to do it, we would definitely need to bring in a partner that's very, well versed at that. And it's something we've talked about, but I think the attractions that we offer our investors is pretty immediate, cash flow. So particularly with these typical value add multifamilies, they're going to get cash flow, typically in the first quarter. It'll be lower than the average annual cash flow because we haven't gone in yet and upgraded the units and increased the rents, but they're still going to start getting distributions in the first quarter. And that's obviously something you can't offer investors typically in ground up, unless you're pre-raising it and giving it back to them.
Yeah, no doubt. Very different animal, as far as how it, works for investors, and it's not for everyone. I guess, are there other thoughts about multifamily versus ground up that even maybe a passive investor listening should be considering? Because obviously it's like we talked about cash flow. If you're wanting cash flow in it right now, a ground up may not be the space, right?
Yeah.
And I know that typically I would say more risk, right? Because there is no cash flow, right, for a long time. But any other thoughts, as far as for the passive investor listening?
Well, I think that's exactly it. There's more risk, right? Conceivably, there's more returns, more rewards, so your return should be higher for that additional risk. But, I have invested passively in a ground up apartment complex, and that was located in Los Angeles in a high-end area called Hancock Park. And it took, I want to say, a year and a half over when it should have been completed to actually be completed. So, and these were very experienced people that own quite a lot of apartment buildings in Los Angeles. But you're dealing with, a lot of times it's the government that's delaying you in the permit approval process. And that was the case here. So we were dealing with the city of LA, which is a very bureaucratic, city, and they're very slow moving. And we were dealing with the utility companies here that have their own separate bureaucracy that you're dealing with in terms of getting the electrical components approved and signed off on it. And so, one of the biggest risks is how long is it going to take, and just be prepared for that, because that's going to water down your IRR. If you think you're going to get your money in a year and a half, but it takes 3 years for the money to start rolling in, that has a significant impact on your overall return.
Yeah, no doubt about it. I find that if somebody says, "Oh yeah, the ground up development, whatever the project may be, oh yeah, it'd be done in February," I'm like, "Well, what year are we talking about?"
Right.
I may add a year to that, just to get my, set my expectations, because there's so many things, right? That and rightfully for any developer in multifamily value add operator as well. There's just so many things that come into play that you can't expect. We try to account for all those things, right, as much as possible, and even allow buffers. But sometimes there's just, I would even say often, there's just things that you can't.
You're running an ongoing business, and things come up, and you just have to, be ready to deal with it as best that you can, and be prepared for it. And as you're saying, if you can build in some buffer to protect you from unforeseen downsides, some contingency budget funds, that's always, I think, a good idea. And just be prepared to walk through those issues that can come up. And as an investor, I think you need to recognize that you're not investing